you can't sleep with two women and have a baby in 4 months. You must wait.
If you look back to that time and
Yeah.
from your experience, what are top 2 or 3 reasons why some businesses don't do well?
There's a difference between the technical and commercial aspect of every business. Being able to make the sweetest cake, you're technically sound, you're the best baker, nobody will take that away from you, but can you run a business? Everything takes time. I think that it would have been impossible to build Sycamore to what it is today without Onyeamaewa, right? I think co-founders are priceless in every business because it's easier to do it with somebody. So you're sharing a lot of mental, emotional, technical, everything. You're sharing it with more than one person. And I mean, even if we go back to our classic biblical saying of 2 heads being better than one, for us, it was really the fact that 1% of all the credit that was going out in Nigeria were going to SME.
1% of all the credit that goes out in Nigeria goes to SMBs. And that's what you were looking to solve with Sycamore, was to expand that from 1% to something slightly larger.
Yes.
Welcome to Periscope, the podcast that allows founders see what they may not already know. We are here to break down all the topics that will allow you to scale that wonderful idea from 0 to 100%. Whether it's fundraising, finance, marketing, tech, all the messy bits in between, legal, compliance, regulatory, this is where you're going to hear all about it. My name is Lola and I'm the host of the show today. And with me, I have Tunde, and I'm so pumped to have you with me because you are the real deal. You really are. I mean, you're a finance guru, and I respect the depth that you have built in the finance space.
Thank you.
You've worked with PwC.
Yep.
You've worked with KPMG.
Yep.
Worked across tax, advisory, finance strategy, and now you are building Sycamore, which is a financial lending institution. I'm sure I didn't get that right, but you can break it down for us.
No problem, I will.
So please say a few words about yourself and introduce yourself to our guests.
All right, thank you very much, Lola, for having me on Periscope. My name is Babatunde Akin-Moses, but you can call me Tunde. Some call me Uncle Tunde. That's a different story.
Okay.
So right now I'm CEO of Sycamore. Sycamore is a borderless fintech, and I say borderless because we also serve people across the continent, and we help Africans get access to credit, savings, and investments wherever they are in the world, right? So the whole idea is to serve these businesses anywhere you are, even if you move from here to London. We're still on that journey, but that's the eventual goal.
Amazing.
Yes.
Amazing. Clearly you love finance.
Yes, I do.
You studied it, you've worked in it for years,
Yes.
and you're now building in finance. And I'm
Yes.
sure that has helped you effectively build your business.
Absolutely.
But I'm sure you must also see other founders that may not fully appreciate what finance can do.
Yes.
So tell me more about your experience with that.
Okay. I think that when we look at the wave of a lot of the fintechs that have come up in the last, maybe say 5 years, right, especially from the zero interest era where funding was flowing, there were a lot of digital banks that sort of came and gone. And when I was analyzing with a few people, what we saw is that the tech was fantastic. These were fintechs after all, right? Tech was on point, but the finance wasn't so great for a lot of the people that, should I say, didn't make it. And it was really around the back office operations of what kind of funding are you getting? Are you using the right licenses? So because there's the business of finance, before we start talking about tech, because sometimes when we talk about fintech, a lot of people think more about the tech.
Towards the tech.
Yes.
So the fin in fintech.
In fact, that's been an age-old debate in our company about are we more finance or are we more tech business, and then we have that debate. But it's a balance, right? Because if you're running a digital bank, for example, you're still a bank at the end of the day, and the technology is a means to an end. So I think we need to see more appreciation of that finance in fintech that will make it more robust.
I'm sure things can go very wrong for those that don't fully appreciate the business of finance within their ecosystem.
In fact, if you listen to this prominent founder that says the business didn't start working until he went to go and learn finance, was building a fintech, struggling. What's going on? Why can't I figure it out?
Fintech. Like, I don't really understand that. How can you not? You don't understand finance. Finance. You're building a fintech.
Yeah.
Is that simply for vanity, or that was the hot space to be in, and so you kind of dabble into it?
That was the hot space to be in. So the first YC company in Nigeria, I'm not even sure, maybe Africa, I'm not certain, Paystack, 10 years ago got into YC. A few months later, Flutter with both fintechs. The most prominent unicorn now is a fintech. So it's fintech. There's a hype. It's hot. So you go in thinking that you don't need as much finance because you're seeing a lot of product managers, a lot of software engineers. But this is a finance business at the end of the day, right? Especially for fintech and even other aspects of businesses, because you need finance in any business.
But I really like what you said earlier, that founder appreciated the fact that they didn't know finance and they had to go back to learn.
Absolutely.
So even when you find yourself in a situation where you don't necessarily have the domain expertise, having the courage to accept that you don't know and then going to get the knowledge is actually quite valuable.
Absolutely.
And for non-fintechs, right? So for businesses in the real sector or FMCG or any other sector, how do you see finance as a key part or as a key driver for their growth?
That's a very critical question. I think that if you look at some critical aspects of your business, funding, cash management, finance helps you understand that it could actually be a competitive advantage if you use it well. For example, we talk about fundraising, and everybody thinks about, I want to get equity. But there's debt, right? And there are different types of debt. Even equity, there are different types, right? And there are different flavors of it. And there's something that is appropriate at each stage of your business, right? So you get equity when you're probably starting out. When you want to grow, you get debt. And which type of debt do you get? It's going to be private, commercial paper, overdraft, bank loan, everything, right? And some people are using these things very well, and they're scaling fast. But you just want to raise money and you think you have to go and get equity again. Not necessarily. If you're 4 years old, 5 years old, you can actually explore debt, for instance, right? So some of these nuances is what differentiates some businesses, and you see them doing well, and you've not studied or learnt about it, so you don't even know, and that then puts you at a disadvantage strategy-wise.
Amazing. I can't wait to delve into this with you. The topic of our episode today is the CEO's Guide to Financial Fluency. And there's no one better to discuss this with us than Tunde. I'm so pumped to have you here with us and to begin to break down all the elements of finance that can allow our founders to be successful.
If your CFO quits today, what are you going to do? How will you survive?
That's a great question. If your CFO quits today, can you still survive? Let's get into it. Cascador is our partner making today's conversation possible. If you are a mid-stage founder, then Cascador is for you. It's an intensive program that combines education, leadership, mentorship, and access to a $2 million catalytic fund to allow you scale your business. Whether you're looking to refine your leadership, pressure test your ideas, or get connected to a community of advisors, Cascador is the place to allow you do that. Apply for the next Cascador program at cascador.org. So the topic of our episode today, Tunde, is the CEO's Guide to Financial Fluency.
Right.
And I'm so glad we are having this conversation, because I think a lot of founders don't fully appreciate how finance can either drive their business upward or actually derail their trajectory.
Absolutely.
And I want to break that down with you.
Okay.
But before we do that, I want our audience to truly respect your finance chops, right? Because you have really deep domain expertise in finance. You've worked across a range. Because when people think of finance, they think of accounting.
Yes.
Finance is not accounting. We all know this. So why don't we start by you just walking us through the different elements of finance and then the parts that you have touched in your career.
Right. Thank you, Lola, for having me once again. And yes, so finance is actually really broad. And I think if you look at it from the different elements, you then start to appreciate just how robust a finance unit in a company should be, right? So if if I was looking at it from different aspects, we can talk about it from accounting, which deals with like reporting and how you know, just really record your numbers. And we can talk about tax, which is the government's
Which is
share.
also different from bookkeeping. So
Which is-
accounting and
yes,
bookkeeping are a bit different. So just
Yes.
tell us about the nuance between those two.
Yeah. Bookkeeping is sort of like, how do I put it now? It's basically like recording.
Yeah.
Right. Bookkeeping is not as technical as accounting. So accounting is broader. So if you take like those of us that did ICANN or ACCA or something, if you're doing accounting, you won't actually do a bookkeeping course because it's really just basic record keeping. So what you would call it is rudimentary. Yes. So accounting is what most people know as financial reporting, right? So how do we keep our income statements? How do we keep a balance sheet? What's our cash flow? This one is all just technical stuff, right? So I would say accounting. Think about it like bookkeeping on steroids, with a more technical and rounded bits, more structured. You have standards we need to follow, right? For IFRS, we're following IFRS standards because there are accounting policies and principles that should be followed. Again, for the businessman, I don't think you need to go that technical. You just need to have a basic understanding of how it drives the business because somebody said that numbers is the language of business, right? And finance is all about numbers. And you need to be able to speak the language of your business to communicate its performance. So accounting is just one part, right? We still have corporate finance, which is about like capital structure, fundraising, liquidity management, stuff like that, right?
So
and
that's treasury fall under
treasury,
finance.
yes, to some extent, right? To some extent. So it has to do with how you managing your idle funds, how are you getting your funding, is that equity, is that debt, which is why even when you look at it broadly, the professional course for corporate finance is CFA, right? Chartered Financial Analyst. That's different from ICANN, which is accounting, right?
And ACCA.
And ACCA, for accounting. And then we also have tax, right? Tax.
So even when hiring a finance
person,
lead manager, it is important to know what qualifications they're coming with.
Absolutely.
Because if you're trying to hire them to help you with fundraising,
Yes.
but if what they have is ICANN, it may not necessarily translate.
Yes, absolutely.
Or vice versa.
Vice versa, yeah.
Right. If you want someone to liaise with your auditors, it may not be the guy who has the CFA or the lady who has the CFA that can effectively liaise with your auditors.
So that's an excellent point because when you're picking a CFO for your business, you need to then assess what exactly you really need, right? A lot of times, CFOs are usually accountants first. In some instances, they are CFA guys because of just what you want to prioritize. And in fact, even for CEOs, right? I think for the conventional wisdom was that when you are hiring a CEO, it should be a domain expert. So if you run an oil and gas company, for instance, your CEO should probably be an engineer or something, right? But guess what? I did my youth service in Shell before I went to KPMG, right? The CEO at the time was a finance person, right? The CEO, global CEO. But that was for a reason. That was because we just had a financial crisis in 2007, 2008, right? So everybody's thinking finance. So it wasn't out of place for them to have made the CFO the CEO of an oil and gas company.
Got it.
Right? So it's also, should I say, the phase of the business, what you're trying to optimize for, and really what you're trying to position the business for as well. Because if you're thinking about fundraising, for example, you might be thinking of maybe a CFA type guy for your CFO role. But if you are more worried about your financial reporting because you want to be applying for maybe grants and stuff, then you get an accounting person.
And to extend that thinking, right, if you were a pure tech person, you may then find that a technical and someone with a strong engineering background might be more suitable to be the CEO of that business.
Yes, absolutely.
Right, or if you are a heavy, brand-driven company, you could be that the CMO potentially steps or sort of goes down that road.
Absolutely.
So understanding the business model, understanding the product and what you are selling also can determine that trajectory to the to the CEO seat, essentially.
Yes, exactly. Yeah.
So back to finance, you were
Yeah.
discussing tax. So tell us about, so now we've touched on accounting / bookkeeping.
Yeah.
We've touched on corporate finance. What are the other elements of finance broadly?
Yeah, there's also tax as well, right? I can say tax is probably the last trifecta in that tripod of accounting, corporate finance, every other thing. There are lots of sub things in all of that,
audit?
right?
Audits, would you say it's a separate leg, or audit would fit under?
I would keep audit under accounting, right? You can also talk about cost accounting, but it's not so. You learn cost accounting as part of ICANN, for example, and it's not. I don't say it's not relevant to all types of business, but when you are doing CIMA, which is the Chartered Institute of Management Accounting, it's more relevant for like manufacturing companies because you need to determine your contribution, your unit cost for one output of making something. CIMA is not very popular in Nigeria. It's there, but it's not as popular, say, ICANN or CFA as the like. So yes, I think broadly, you can then have domain experts even in any of the sub branches of any of these things. But if you are building a company, as you scale and as you grow, you then start to think about it in terms, okay, who is my financial reporting expert? Who is my corporate finance, my liquidity, or my treasury expert? Person. In fact, there's budgeting as well. There's budgeting, right? But usually budgeting is a planning issue. So if you go to multinationals, they have like a planning team. These guys work with the strategy guys, FP&A. So that's it. Exactly. But if you go to most FP&A's units, they're mostly ICANN people or ACCA guys, right? You're not necessarily looking for people that do like CIMA or something special in budget or cost accounting, right? Again, as you grow the business, you have to start learning some of these things. I like to contrast it with HR, right? So let me give an example. So if you're building a human resources team, there are sub-functions. So there's recruitment,
which is always the default. People assume that
HR is just recruitment.
And then paying salaries.
Yes. Right? So there's compensation and benefits, which is a sub unit under HR. There is learning and development. There is employee welfare. There is talent management, L&D, performance management. All these things, you need to think about them, right? So I always say too, if you're thinking about finance, don't just think about, it's accounting. You're thinking about it, okay, my liquidity management, my budgeting, my fundraising or fund management or for whatever I call that, right? And my reporting as well, and my taxes, right? So most units, if you dig a little deeper, you see that they're always like subdivisions and that's how finance is. So that's why we talk about corporate finance. We talk about reconciliation. You have a reconciliation team, you have a budgeting team. Obviously, for a small business, you have one or two people doing all these things.
Doing everything. But at least you need to know.
You need to know, yes.
As you evolve, you can begin to specialize.
That's what it is.
That's actually fantastic insight, which is, as an early stage founder, yes, you need a finance person, and they can be broad, and that's perfectly okay because that's your need at that point in time. However, as you evolve and as you get more sophisticated, you have to be aware of all the various elements of finance that you need to consider. Maybe your current team can fill in those gaps, right? For fundraising, corporate finance, for accounting, for audit, for tax. But maybe you reach the size where it's time to begin to specialize. And finding the right people with the right background, expertise is absolutely critical for success.
Absolutely.
Now, what got you interested in finance? Tell us why you got into that space.
The funny thing is that I didn't even like finance initially.
Okay.
That's the very funny thing. So I was a science student in secondary school.
Okay.
And my dad was a medical doctor. And, I was about to do JAM, and one day my dad woke up and said, he looked at, Charles Soludo was CBN governor.
Okay.
And he looked at it, he said, this guy, first class, he's now CBN governor. He looked at, this was Obasanjo's time, right? He looked at Okonjo-Iweala.
Interesting.
I said, first class finance. He said, Tunde, this medicine that you're doing.
Might not take you to hospital.
Take me to, because apparently he always seen success as a minister, Entrepreneurship
Right.
wasn't even in the picture back then.
Right.
And so we started looking for something related, and economics came up, right?
Okay.
So it wasn't even called finance initially.
Okay.
So did economics.
And are you the first child?
No, I am not.
First son?
First son.
Okay.
First son. Yes, first son. I mean, the whole essence of doing economics. So between both of them, those two people, because he mentioned them when he asked me to leave medicine, I was supposed to do, and go and do. He said, okay, you know what? This is the plan. Let us do it's me.
Yes.
Let us do economics. We'll get make sure you graduate very well, first class or 2-1, so that you can be like one of these guys in the future. Like Ngozi or Charles Soludo. That was the pitch. And that's how I got into economics. But my first real finance job was actually my NYC, which was with Shell.
Okay.
It was the business finance team, right? Again, very long story. We don't have time to go into it, but that was the first finance team I actually worked with. And that was when I even really started understanding, there's costs, accounting. There was, this team was for budgets, but they were all chartered accountants in the budget team. They all had ICANN or ACCA at the time. And one of the people on that team was the one that told me about KPMG.
So prior to that, you had not heard about KPMG?
I thought it was an engineering company
at Shell. That is fascinating.
Yeah, I didn't know. It wasn't a dream of mine. In fact, I wanted to do. I was good at math, good at science, but I also had I also had a creative side. So I liked advertising and marketing. Because I thought, maybe I'll do something along this line.
And Daddy said, no, that's not taking us to Astro Rock.
In fact, it's not going to take us to Astro Rock, but fast forward, I eventually got into KPMG from Shell, and then and the rest is history. So we started consulting, initially tax, but the good thing about working with tax is, especially when you work on big projects, let's say we're doing a deal now, for example, and you're going to be paired with the corporate finance team. We always reviewed financial statements anyways, so you're working with the auditors, you're working with the guys that, everybody there is a very light team. In fact, sometimes forensic guys are even involved, which is part of the things I really appreciated about the Big Four, right? Because the breadth of...
forensics guys.
Yes.
Okay.
I'm just giving you like a full range of financial experts,
yeah.
Right? So on a large engagement, you can have people from people doing financial reporting, same big project, people doing tax, people doing fundraising, people doing forensic, people doing internal audits, people doing IT audits. It's funny, I don't know how IT audit always made it into those firms, but it was there as well. So that was what really started that whole finance journey. And as much as I was very skeptical about accounting because of debit and credit, particularly because I've always been a numbers guy, but I'm more like the YDX because from economics,
right?
And now debit and credit.
Yeah, the YDX.
The YDX, right? Yeah, exactly. So I really struggled.
Differential equations.
Yeah. So I always sneaker, what is this? Why are we giving us rules and principles? But it turns out 10, 15 years later now, that has been one of the biggest sources of strategic and competitive advantage for the business. That foundation, right? Yes, because it made so much difference in terms of just, so from two perspectives. One, the financial knowledge itself. Then there were other values we got from the firm. We used to work and if you heard consulting stories, used to work
late nights, long days, weekends.
That rigor, that rigor and bar for excellence, right? Sort of stayed with me. And then just having to work on so many businesses, you get to see why some businesses are succeeding and why some are failing. From an outside view, and you're just taking knowledge, even if you don't know why or how it's going to pay off in the future. So a lot of those lessons have sort of stayed and now really, really helped as we're building the business.
And if you look back to that time and from your experience, what are top 2 or 3 reasons why some businesses don't do well?
Wow. Man, top 2. I'll struggle with the top 2 because there are so many, right? I think you touched on it a bit in your earlier point around there's a difference between the technical and commercial aspect of every business, right? So let's take, for example, I'm doing fintech. There is a okay. No, I'll come back to fintech. Let's take a baker. So if you want to run a bakery now, for example, you could be the best. You can make the best cake in the world, right? You can be the best baker. And you want to start a business based on being the best baker in the world. The fact that you can make the sweetest cake, it doesn't mean you can run the business. So there was always the commercial aspect of the business. Being able to make the sweetest cake, you're technically sound, you're the best baker. Nobody will take that away from you, but can you run a business, right? And I think sometimes some technical experts don't spend enough time learning about the commercial part of the business.
They look down on the commercial part of the business.
I think you take it for granted because it's like, oh, now how hard could it? I'm just going to sell. I'm just going to sell. I'm going to make this cake and I'm going to sell it, right?
It's trading, but it's a lot more complex than that. Clearly.
So that I think that is very critical in terms of knowing, okay, this is technical, and one of the solutions that is partnerships too, right? Which is, so if you're good technically, then maybe you partner with somebody that is commercially good, which is why if you are doing a health tech startup now, the doctor and software devs like, oh, this is great, investors like it, something like that, right? So there's that. I think that is very important. And I think sometimes we also underrate just how difficult it could be. In terms of from a persistent standpoint, yes, from a grind, it's like that's a more valuable whatever than intelligence, persistence, right? Because you
almost a mental challenge.
Yes, and it's tough, especially if you, and it depends on your own context to where you're coming from. If you're like coming from 9 to 5 like me, you had a good salary, like what's all this, like I'm going back,
why are we doing this?
Why are we suffering here, right? Or you just, maybe you're not getting the results you want anytime, and everything takes time. It takes time, right? There's no
shortcuts.
There's no shortcuts. Like the example I always use is, you can't sleep with 2 women and have a baby in 4 months, for example.
Wait, let's break that one down. You cannot sleep with 2 women and have a baby in 4 months.
Yes.
Because a baby always takes 9 months.
It must take 9 months.
So you can't divide it amongst...
You cannot do... You can't... In fact...
You can have 2 babies in 9 months.
You can get 9 women if you want one. You think you want to get 9 women because you want a child in 1 month.
In 1 month. Doesn't work that way.
It doesn't work. You must wait.
Yeah.
Like, you must... So, I held on to that very strongly, even if it was very difficult. So you start a business and then, people are not going to trust you immediately, except you have big budget for marketing and stuff. But even at that,
and even that, it's not sustainable.
It's not
so
sustainable.
You may get the initial uplift, but you may not necessarily keep it.
So it's very difficult to stay till you start seeing the kind of results you want, and it takes different time. People ask, anytime I say this now, people always ask, oh, okay, so when is the correct time? Is it 1 year? Is it, if it's not working? And I say, there's no template. It depends on the business, it depends on your staying power and your personal circumstances. I won't lie to. Like, I always say that because if you're from a rich family, you have more bandwidth, for example. I'm just giving an example, right? If you have bills to pay, you cannot wait as long as somebody with a trust fund.
Right. And we always see that. I mean, if I think about, young founders, especially in the Western market, where there's a trust fund, an inheritance, the father can write a check, or mother as well, right?
Absolutely.
For X thousands of dollars, that clearly gives you much longer runway.
And
than others that may not have that luxury.
Absolutely. And the richest entrepreneurs, a lot of them were funded first by their family and friends. They don't say it a lot, but if you look at the data, Jeff Bezos, Elon Musk,
to Bill Gates,
this where that's the reality.
Wealth. That's a whole nother episode that we have to actually dive on. Is the value of generational wealth and how that compounds over time. But that's also a finance concept, right? The idea around compounding. In your case, it's time. The fact that your staying power in that business compounds over time to allow you grow and to allow you, learn, pick things up, and use that knowledge to effectively grow the business. Now, you decided to go for your MBA, right? So you worked for several years. You picked up that knowledge over time, whether it was at Shell, KPMG, PwC, etc.
Yeah.
But you then decided to go to business school. Tell me why that was critical for you. Why wasn't your time in industry sufficient to catalyze you to the next step?
Yeah. Interestingly, I always wanted to do my math. I think we had this thinking of you do your master's after university.
You must do a second degree.
You should do a second degree, which also
one is not enough.
No, it's not. Then you have to go back to my dad's, this thing of also do a professor, Dr. Goji, PhD. You have to do something, So we had this big fight after university where I was supposed to go and do masters, and I'm like, no, I'm in Lagos now. I've spoken to people, and everybody is like, get work experience. All the people I engage with, and so I said, okay, I'll do get work experience. And I was getting work experience. It was getting close to 7-8 years. We were having that conversation every year when I go into masters. So while we already had that pact almost a decade ago, for me, it was an opportunity to transition to entrepreneurship.
Okay.
That's the way I saw it.
You always wanted to go into entrepreneurship then. Yeah. That has always been part of your own professional desires.
It was in university I sort of made that call. Again, we won't go into that story, but I did an internship with a very interesting entrepreneur, and I said, oh, okay, I'm going to try entrepreneurship. But a lot of people I admired had done like 10 to 20 years work experience. So what I said was I was going to work between 5 to 15 years. Then I'm going to go and do entrepreneurship. I didn't tell my dad down.
So you felt that the work experience was critical for success in entrepreneurship?
Yes, that was my view. I wasn't again, I've always been studying like successful entrepreneurs, right? And when I looked at people like, I didn't think I had the sort of family advantages that people like Bill Gates had, or Mark was not that big yet, or people like Jeff Bezos even worked for almost 10 years before,
That's right. Was on Wall Street.
Exactly, was on Wall Street. So I said, okay, I think the more practical one for me would be to work for like 10 years. So I told myself that, and to my parents, it was more like you're getting credentials to be minister.
Yeah,
that was why you're going to do masters. So we had different reasons. So for me, it was, and that's why I did a full-time MBA, right? To sort of my mantra then was, this is where I'm going to transit from employee to entrepreneur. Like that's what I said on my first day when getting there. Why are you guys here? I'm here to transit from employee to entrepreneur. No idea of the business.
Yeah.
But I just sort of felt I needed that stuff. And I mean, I also did it in Nigeria, even if a lot of my friends were going abroad, but I always
discuss that. Why did you choose LBS? Why did you choose to stay in Nigeria? Were you married? Was it that you had
married? Okay. In fact, I only made my
decision, or what was the thinking as to
so there were many,
why not the foreign option?
Yeah, I mean, that's an excellent question, and even written about this extensively before. I think the way I looked at it is, so one is I'm very big on Africa and Nigeria, very, very patriotic kind of person. Always encourage people to stay, right? So that one is there. That's always been there. But secondly, I sort of now I was looking at the advantages of building from a network here from a business perspective. So if I'm going to do business here, I need to be linked with the business community. And as much as I was already getting that from consulting, I felt like there was a deeper need to even expand on that network from a Nigerian and African perspective. And at the time, LBS was already like top 3 in Africa. So I said, okay, I could always do another degree in the future. But if I want to really get into, based on what I knew, because I'd done my research, and there were a lot of very, very prominent business people that have faculties in Nigeria that are already affiliated with LBS in one way or the other, right? So that was the bet I made. And honestly, I also, when I looked at it from I think you get a lot of value for money compared to, it's not cheap, but I think you get a lot of value for money when I this thing right now, do I want to try and go to Harvard? And I was also worried about a lot of my friends that were going to very top schools need to get loans.
And having to pay back.
And having to pay back means you have to stay. We're talking like $100,000 upwards.
That's right. You can't come back to collecting Naira salary.
No, you can't pay. Yeah. So again, it was also that long-term camp building here.
And you didn't want to stay outside the country. You
No,
wanted
I
to
wanted to
build
do it here.
Nigeria.
Yes, that was
That's
very,
always been clear.
yeah. In fact, somebody was even yapping me that why not go to a proper school? What are you doing in Lagos? You have this, you have that. You should be Stanford, Harvard. Look at your people. Your friends are going here. I'm like, look, I'm staying here to build almost immediately, and I know that if I go, I'm going to have to do student loans.
It was very intentional. You
Very
had thought
intentional.
through.
Yeah.
So you had run your cost benefit analysis as a true finance professional.
Yes. So the thing is, I sort of, from the time I was going to youth service and making entrepreneur, I sort of almost gamed out the next 10 years. And this was sort of like part of that whole thinking and plan of like, okay, I am definitely going to transit and this is how I'm going to do it. And again, I wasn't too worried about having a big, going to a big school because I could always do that. And luckily, it was even a shared degree with ESA in Spain anyways. So I ended up going to ESA for my last semester. That still got me, very, very interesting. Yeah, the exposure and stuff. Yeah. So that, I think I just sort of made that trade-off.
Okay, all right, fantastic. And you met your co-founders at Elbia.
So yes, that was another.
Two other co-founders. So it's three of you, or it's
two other co-founders, three of us. Yes.
Okay, yeah. So let's spend some time talking about the value of having co-founders with you on that journey.
Yeah.
I wouldn't ask for any regrets because they're still your co-founders.
Yeah.
But do you think it's easier to build solo versus having a co-founding team, pros and cons of each one? Then we'll delve into the business that you build together. Right, and how you're leading that business.
Yeah, absolutely. I think that it would have been impossible to build Sycamore to what it is today without Onye and Maiwa, right? I think co-founders are priceless in every business because I just mentioned just two aspects of the business. I mentioned technical and commercial. We can dissect it into more stuff. But if you look at it from those two broad perspectives, it's easier to do it with somebody if you can't take both of them at the same time, right? So you're sharing a lot of mental, emotional, technical, everything. You're sharing it with more than one person. And I mean, even if we go back to our classic biblical saying of two heads being better than one, or three in our case, it just makes it easier. We met, it was so, I wasn't thinking about it. But we were just having lunch and we're talking about the chances of starting businesses, and some people were more inclined to doing a business. But as it is for MBA, some people just want to go and get a fatter salary
afterwards.
Yeah. So we all had different objectives. So I think the first thing I was looking out for, okay, these guys are actually interested in building. That was like the first sort of mental check, like okay, so maybe. And then in class, we're talking about financing and credits. We're just looking at data, right? When you see some kind of interesting data and you're just like,
there's something here.
What's going on? Yeah. And for us, it was really the fact that very few, 1% of all the credit that was going out in Nigeria were going to SMEs.
1% of all the credit that goes out in Nigeria goes to SMBs. And that's what you were looking to solve with Sycamore, was to expand that from 1% to something slightly larger.
Yes. So from even an opportunity perspective, because where I downloaded a CBN report. I was looking at sectors, it was oil and gas, and I saw SMEs in one big bucket of 1%, and I'm like,
just all combined.
And this was like trillions of naira. I'm like, this is like, so they have all this, you have millions of businesses, and this is just so tiny. Like, there's a big opportunity here, right? And that was like, okay, let us try to solve this problem. And interestingly, it was a very complementary combo, because Onye had actually been in the consumer finance industry. I was in consulting, right? As much as I was doing finance for other companies, it's not like I was selling financial products. Onye had actually sold financial products, right? And that was a lot of insights she brought, helped me understand a lot of things that I thought I knew technically, but she brought a lot of practice, and that's always invaluable from a practice perspective. My dad worked in insurance, so he knew a lot about risk. Loans is risk management, really, right? that money must come back. If not, you're not in business. It's not like a payment where once you pay, you've paid now.
Yeah.
Payment, and we
Yeah.
process our payment.
Yeah. You have
Loan
to monitor, track.
it has to come
It
back.
has to come back.
That's the only way it makes
With
sense.
interest.
With interest. With interest. You know, so I learned a lot from both of them. But I mean, I also just brought in that whole like business. I always had like a very, very good view of like the strategic landscape and competing and stuff like that, because personally I've always been interested in strategy as well, from just reading and wanting to do business.
So your roles were also quite clear from day
Yes,
one.
from day one.
You didn't have any conflict on no, I want to be the CEO, no, I want to be this, no, I want to be that.
We didn't actually. We didn't. It was quite clear, but the thing about it is, as clear as it was, we had to do multiple things. So if, for example, because nobody there was resigning fintech, none of us was a dev, for example, right? I had to take on technology. I was the most interested and maybe had more interest and slightly more knowledge, not from a coding perspective, on just architecture. Yes, exactly. So we all had to do multiple things, wear multiple hats, even if we're leading with something in terms of expertise. Again, because we had all worked for that same level of 7 to 10 years type. So we're not even going into the industry as like spring chickens in terms of like, or greenhorns. So like, okay, we had an idea of what to do. But that, I mean, there are also pros and cons to knowing what to do, because
you might be overconfident. You might think you know it all.
Yes, there's some level of overconfidence, one. And I think there's also, I feel like maybe we could have taken more risk in terms of what we would have tried. I think early on we sort of made a lot of very safe assumptions, right? Which was part of what made raising VC funding a bit difficult for us, because if you look at the financial model that I did for the business, it was so realistic. And I thought I did, but I didn't understand the VC model very well, where they want to take over the world.
Right.
They want 1 million X.
You have to be VC backable.
The first 6 months, my financial projections were in point, because I knew how many customers we could get, and where you're going to come from.
Right.
And we're going to see. It was very, very precise. And a lot of people just like, you guys are not thinking big enough.
You're small.
Yes.
But you think that good VCs should respect that. Should respect that discipline. Should respect that sort of sense of just reality versus selling.
You know, one of the things I learned like 2 or 3 years later is, I don't know if this will sound somehow, but it now looked like we're being punished for not lying.
Yeah, exactly. Versus selling dreams. I want to call it that.
Yeah, because a lot of people that were saying stuff and were raising money, we knew them and we're like, you cannot do this thing. You can't.
And I actually think that also speaks to VCs in some cases not educating themselves enough.
Well,
right?
True. Possibly.
They're so eager to find the next big thing. They may not spend time to truly say, actually, this sector, what can this market accommodate? Right. What can we, what size loan book can the market absorb? Right. And have decent repayment rates.
So it was, in fact, I think overly practical, pragmatic in, I guess my true nature self. But what I was trying to also explain is, look, we're thinking big, we're starting very small. But maybe the small was now too small, I don't know. But it was a very, very pragmatic way of really starting the business.
In hindsight, are you glad that you did that though? And
yes,
you didn't
absolutely.
take VC money that then puts some pressure on you.
Yes.
That allows you to make decisions that may not be in the best interest of the business.
Absolutely. So I think that it would have been great to get a little more money than we did, because we really just suffered the first few years. It would have been great. But in hindsight now, one of the challenges a lot of businesses that's been starting in the last 5 again to 7 years are having now is that they overinflated their valuation. And now you can't get 5x of that valuation again, because the initial one before the devaluation was already puffed. So give you an example, somebody raised $10 million at a $50 million valuation with less than $1 million revenue. Do you understand? These are all empirical numbers, although there are some few guys who probably fit into this, but so you do that now the Naira is devalued. You raise at a 15 valuation. To give somebody just 3x, you need to be valued at 150.
150, yeah.
you were
When
less
you have
than 1
million,
yes.
revenue,
So how are you going to
it
get
doesn't
there?
add up. Yeah.
Exactly right. So because we've sort of grown more organically, even if we eventually did raise VC, even if it was small, I'm in a very, very good position now to give our initial investors a very, very good return based on the more conservative valuation that we had then, right? So everything now looks like 20x, 30x, 50x. I hope to give some people like 100x in the next 4 years, right? So
why didn't we know each other back then?
I don't know where you were.
I didn't know where you were.
Anyway, and that is my fault, actually. That I take the blame for not understanding marketing enough.
So let's talk about what you've built with Sycamore. We are two co-founders, Onye and Mayowa.
Yes.
Tell us about what Sycamore truly is. How would you describe it?
Okay. Right now we are a fintech group, right?
So you say right now, meaning that might
It has
evolve
changed.
and it has changed in the past.
So both answers are correct.
Directions,
Both are correct because we started as just peer-to-peer lending.
Okay.
Just aggregating because we didn't have money for banking license. There was couldn't digital bank. How could we get loans? So there's peer-to-peer model. We read up on the model in the UK, US. Okay, let's get this platform built, bring lenders, we get borrowers. That sort of had issues with scaling because a lot of people didn't want to do the loan underwriting themselves. Because how P2P is supposed to work, it's supposed to be a marketplace, you're supposed to see Tunde and Co, Lola and Co, and then you come, you say, oh, I like this risk appetite. Take 10% and they say 8, and then there's some sort of bargaining, and then you can give them the loans and take a transaction fee.
Got it.
But what eventually has won, even if we still have that model in place, but it's contributes very little now. It's just pure credit.
Okay.
But as we've scaled, we've
Credit to
acquired
individuals as well, or to businesses?
businesses,
Or to
both. But I would say 80% businesses.
Okay.
So as we've grown now, we've had to, as the business has evolved, there's been more banking needs.
Okay.
So people wanted like more banking services. So we've had to acquire a digital bank. Yes.
Paying bills.
To be honest, even regulator even sort of enabled some of it because when the volumes were growing, we're using a bank and they said, oh, CBN came and said, oh, which account is this? These volumes are much. What are they doing? It says a lending business. So they say, no, this guy has to go and get a microfinance banking license.
Okay. So now you have a microfinance banking license.
Yes. So we have a microfinance as a subsidiary because we had to acquire one. So we're still running that as part of the business.
Okay.
But we still have the original entity we started with, but there's a Sycamore Microfinance Bank right now. That's a separate entity. So the credit entity is here. There's a banking entity. And why we kept it like that is because regulatory wise, there are limits to what you can, how much you can lend with a certain type of microfinance bank, right?
Okay.
So there's 1 million limit, 2 million limits, and that's far less than the kind of businesses that we now lend to. And again, that has also changed with time, right? 20 million today does far less than what it could do 5 years ago.
That's right.
So
because
even
Naira has the value.
So your product will have to change in line with that realization. So we have that, and again, because of what's been happening with the dollar, we also went into asset management. And really, why did we go into asset management? Customers also drove us there. So the bank was driven by regulation. The asset management was driven by the customers, in the sense that when the dollar was scattering, a lot of people that were lending on the platform, a lot of people that were giving us debt investments were saying that they wanted to put dollar. And we're like, so what kind of license do you have? Well, microfinance bank can take dollars. Your lending license cannot take dollars. Which license will take these dollars that you want to give us?
I see.
That's how we found, okay, you guys need to go and get an asset management entity. And I'm like,
another one.
That was, and there's a backstory to, a deeper story to that, but I mean, we won't have time to get into it, but that's how we got into an asset management entity. So now that's why I said we're a group now.
Okay.
Even if the services, we found a very smart way to provide it on one app, right? So they have the credit and the tech business that now provides shared services.
Okay.
Again, this is all structuring things that I learned. So things like HR, things like procurement and things like that sit in the original entity, and they provide services to the banking and the asset management company.
Okay. Yep. So I went to your website,
and
I noticed that your clients can earn up to 24% returns on their investment with you, how are you able to give that level of return? Because how much are you borrowing at? You must be borrowing at a lower rate for you to actually give such high returns. How does the math work out?
So lending in Nigeria is actually expensive, to be honest. I think that's one of the areas that people fight with me for, fight us for as a business too, because right now MPR is 27%. So even if you go to a bank, you're going to be borrowing money at between 30 to 35% as at today. And now, because of the kind of risk that we take, where there's a lot of uncollateralized loans that we're giving, some of them are collateralized, we have to charge on a monthly basis, right? So we have to charge between 4 to 5% on a monthly basis, which is why we can't finance certain types of projects or needs. So I wouldn't advise anybody to take our loan for an asset acquisition, for example, because it's too expensive. So most of the guys we try to service are, you have working capital needs that can be filled within 30 to 60 days or even 90 days. And then it becomes like a 15% versus a 60% for the whole year, right?
The whole year, I see. So
Exactly.
it's shorter tenure.
Shorter term, yeah. So we're more working capital.
Okay.
So you have a supply. You want to buy cocoa and sell chocolates. So I'm just going to finance you on that. When you resell, you give them a margin. If you can do it in 30 days, you only pay 5%, which is fantastic for you, right? So it's more short-term working capital needs. That's why most of our companies are either in some sort of manufacturing or servicing companies where they just get inputs. They finance that the effective for them is like 5 or 10% or 15, even if they take it for like 1 to 3 months. So that's how I like to get people to think about it. Because if you're like, oh no, 1 year, hey, 60%, you're not going to do anything. Just think about it from the effective rate that you are financing it at. So 1 to 3 months.
I see. Okay, that makes sense. All right, now let's talk about how our founders can leverage finance to run their business.
Right. Yeah.
So let's go back to the topic of our episode today, which is the CEO's Guide to Financial Fluency.
Yes.
What metrics do you monitor in your business day-to-day?
Right.
What do you advise founders to think about as they leverage finance to run their business, either a fintech or even for non-fintech businesses as well? So let's spend some time just unpacking that.
Yeah. I think that for your business, whether you're fintech or not, everybody says you need to know your numbers, right? And the metrics you monitor actually is based on the type of business that you're running. That's the truth. If I would share some of the things that
you monitor depends on the type of business you're in.
Yeah. So the metrics you monitor depends on the type of business that you're in, right? So for my business now, I have cost of capital and I give capital out, right? So every time I'm checking that my margins are very good from a interest expense perspective, right? And interest income perspective. So I'm always checking that there's that. In my business, I always have to monitor NPLs, obviously, too, and the performance of loans. So I'm also tracking things like NPLs. Non-lending businesses will not have NPLs, for example. Every business must monitor liquidity. And I think we have something
like... How much cash do people have on hand? Cash in bank?
Cash is what keeps this business alive or dead, right? Maybe it's the first thing I should have actually said, because you can be profitable and die, in quotes. You can sell. So, revenue is based on accrual, not, cash. So if I supply you something worth 100 million, I'm going to book 100 million. If not paid,
it still books revenue, die, right? Even though,
exactly.
Cash has not entered.
And a lot of people didn't understand this about, like, let me use a foreign, popular company like Amazon, for example, right? Somebody predicted that they were going to die at some point because they were loss making for so long. And the person clearly didn't understand their business model. This was a popular analyst, but if the person understood that Amazon always collected money up front,
right,
before it delivered
the product,
it always had cash, even if it was doing it at a loss. But they've collected cash today for what they're going to supply tomorrow, so they were always liquid. They always had cash, right? And even sometimes, even when they had cash crunches, that money would always come
back.
Right?
So liquidity over profit.
Liquidity over profit for survival, right? Sustainability, we have to look at profit, even if, some people argue with you because the Ubers and some other businesses of this world have been loss making.
I think Uber is now profitable though.
They're now profitable.
Yeah.
Okay. I know they made profits one time and then came back.
Maybe went back again. Okay,
Yeah,
right.
I don't know the current
So
situation.
yeah.
But yes,
that.
I ideally, I've not checked it out in a while, but ideally, for survival, cash is king. Liquidity has to be monitored like very, very strictly. And in fact, knowledge of finance also even helps you manage your liquidity, by the way, because
What do you mean?
yeah, so it's just like what we're saying now. I was I was reading Femi Otedalo's book, right? And when he was running Zenon in the early days, there used to, once anybody calls him, he supplies diesel. And a lot of people were owing him. So he had so much revenue on paper, but there was no cash, right? So that is also even how you manage your payables and your receivables.
Payables and receivables. You don't want to pay too quickly.
Yeah, yes.
Even though
exactly.
you want to pay your debt, but
in fact, to reduce your receivables, you can give people discount for paying early. This diesel will cost you 10 million, but if you pay now, I will give you for 9.5. The person is going to be more incentivized to pay you. Or if you pay within 30 days, I'm going to give you a discount, right? Or payables, you can apply that to your payables as well, right? We'll pay you more if you allow us to pay after 60 days, right? And those are just very, very small things.
That can make a huge difference.
Very big difference, because it's actually lack of cash that kills businesses. If it's because cash has finished. That's why you're shutting down businesses a lot of times. I mean, the other factors too. But that I think is very, very important to sort of even know the dynamics of your business, right? So from a liquidity standpoint, whatever metrics that you need to sort of monitor that, and working capital management. So your receivable days, your payable days, how many days are you using to pay somebody? How many days does it take them to pay you back? It's something that you also want to be checking. And again, even how you raise money, is part of finance. Very, very big part of finance. I think a lot of
how you raise, who you raise from,
when you raise, yes. So it's type of money required for every stage of the business, right? And it's a bit nuanced because there's some blanket advice. I always tell people you have to go and learn this thing by yourself. Yeah. So so even how you raise funding, right? So you could raise equity early days. As you grow, you have to think about debt. I don't think a lot of people think about debt enough, in my opinion. Maybe I'm biased because I'm in the financing business anyways. But yes, there's also for your tech type businesses, definitely customer acquisition costs.
Yeah, absolutely.
I think a lot of people over-index on like CAC and LTV, those are customer acquisition costs, but it's also very important, right? Because you're not building a scalable business if your customer if it's high.
Customer acquisition cost is high. You have
and
to
it's increasing.
And you're not retaining those customers.
You're not retaining the customers,
those are
right?
Key metrics that actually a good CEO should be keeping an eye on.
Customer acquisition costs, the lifetime value of each customer, your retention rate, your burn rate, how much you're spending each month, and you're checking in with your revenue as well.
Well, that's payroll, your marketing expense,
all your
SG&A.
So usually, yes. So those are the main elements. So when you're looking at burn, we'll check. For a lot of startups, it's human heavy. So payroll is usually very big. Payroll and marketing, I find, are the things depending on the sector. If it's B2B, maybe not so much marketing. There might be some business development costs. Take a client to dinner, you're telling them to buy your software and stuff like that. But marketing and payroll are usually big. Then SG&A so general admin expenses, by the way, that's the SG&A just for anybody that is listening. So those I think, and you want to manage your general admin expenses because that thing can kill your business.
I agree completely.
Because they're not easy to reduce.
By 1,000 cuts.
Yes,
right.
Exactly.
It's a small, purchase here.
Yes.
Another small purchase there that adds up.
And they can be so tough they're not scalable because it's not variable. A lot of G&A costs. So, for example, you've taken a big office, you're paying rent every month, right? Or in Nigeria where you have company cars, you've incurred those expenses, right? Except scaling those things are very painful. Just imagine you have to leave your office, you have to dispose cars, or you have to tell people you're no more buying Mac, you're buying, I don't know, whatever. You're buying for them.
Brand.
That brand, right? So and they just stay flat.
Yeah.
So it's something I think you need to watch very carefully.
So those are some common pitfalls, guys, that you need to be aware of. One, cash flow management is critical. Most companies die because they run out of cash. So it's absolutely critical to understand your numbers and understand your cash balance situation. Second is understand the metrics that drive your business, right? If you're in a lending business like Sycamore, metrics around your NPLs, right? So your non-performing loans, that's what your NPL is. Metrics around your receivable days, payable days are all critical for that business. So you have to understand those key metrics that are quite unique to your industry. So the third point that Tunde has mentioned is keeping very close tabs on your burn rate, right? On those expenses that do not scale with your top line. Because it's very difficult to scale back on those expenses, whether it's your rent, whether it's your assets, vehicles, fixed assets, etc. So planning that very carefully as you invest in growing your business. Fantastic. Any final thoughts that would be good for us to share with our audience today?
Yeah, I think it's critical. We didn't talk a lot about just keeping all these records. Right? Somebody says something, if it's not documented, it doesn't exist. So if it's not documented, it doesn't exist, right? We can't be talking about revenue, cash flow, customer acquisition costs if the records don't even exist, right? So you have to keep those records. And it's not just, I think sometimes we worry too much about the form over the substance. If you need to write it down in paper, if you need to use Google Excel sheet, you don't need an expensive.
Whatever works for you.
Whatever works, right?
SAP or Navision or anything.
In fact, and those things are just blockers that slow you down. You keep those records because those records help you to monitor the business very well, the performance of the business, and they get you into opportunities, right? So imagine, a rich person like Lola wants to invest in you, and they're asking for your last month management account, and you can't provide it. So it also helps you to get access to opportunities. So I think, that's just one part of it. Just keeping those records, even if they're not organized very well, you learn. As you go along, everybody sort of stumbles and you pick it up, but just make sure it's always documented, no matter how rudimentary or scattered or unsophisticated your recording system looks. Just make sure you're keeping as much record and data as possible. It helps a lot.
Amazing. This has been such an insightful conversation today. Thank you so much for sharing from your wealth of wisdom with our audience today. I mean, I have learned a lot from this conversation. So thank you so much for that.
Thank you.
Guys, thank you so much for watching. Hope you enjoyed the show, and we'll see you again next time. Have a great day. Please follow us on our social media channels at Instagram at periscope.podcast, on TikTok at periscope.podcast, on Twitter at Peris Media, and on YouTube at periscope.podcast. You can also see our content on our WhatsApp channel if you search for Periscope, as well as on our LinkedIn business channel. If you have any questions whatsoever, please go to our website and scroll to the bottom to the Slido page and enter any questions that you may have that you want us to address. You can also leave feedback, comments, and compliments for us. Thank you very much for listening.